My name is Jack Hawthorne. I'm the CEO of Keller Williams Heritage in San Antonio, Texas, which is a company that did almost $4 billion in sales last year. We have 1,300 sales associates, and we literally moved the economy in San Antonio. One thing that happens when you're that big is that the community reaches out and asks you about national news that they're afraid may impact them on a local level. Because of this, I have received dozens of questions about Silicon Valley Bank. What's going on? Should our clients be freaked out? What do we want to tell them whenever they're asking for guidance? And so I wanted to make this short video to make sure that you had the answers as a real estate professional so that you can give those answers to your clients and give them peace of mind on how we're going to move forward. The best place to start is, what is Silicon Valley Bank and why does it matter? The short explanation is that Silicon Valley Bank was the 16th largest bank in the United States until a few days ago. They specialized in working with venture capital companies and venture capitalists. So if you were in the VC world globally, the odds are extremely good that this bank touched your life, touched your accounts, or touched your funding in one way or another. An important distinction about this bank as opposed to other banks is that they had a lot of really big corporate exposure. So this is where VC-backed corporations or other big corporations would put their cash in order to pay their payroll, their operations, say for taxes, if they pay taxes or whatever it may be. This was a lot of what Silicon Valley Bank did. However, they did not have a whole lot of retail exposure. So people like you and I, we really didn't do a whole lot of banking there. Other than making loans for venture capital-backed companies, one of the big things they did was also make loans for venture capitalists or high net worth individuals. A lot of high net worth individuals are very, very wealthy on paper, but may be relatively cash poor because a lot of their net worth is tied up with their ownership of their company. Banks like Silicon Valley Bank would go to that person and say, okay, you own 50% of a $1 billion company, so your net worth is on paper $500 million. We're going to loan you $200 million at a 4% interest rate, and that effectively gives you some income you can use, and we're going to collateralize it against your ownership. Not only is this extremely tax advantageous for the person who is taking the loan because it's effectively tax-free income, what's also happening is they're avoiding spooking the market by selling stock because the market doesn't care if the owner needs cash. They just see the owner selling and they freak out. All of these factors, along with the fact that interest rates have been going up very aggressively over the last year or so, is really what led us to where we are today with Silicon Valley Bank. As you probably know, banks use the money that you deposit with them to go make more money. They use it to make loans, they use it to buy bonds, they may do any number of things with it, and that's how banks actually make a profit. The big trouble here is that Silicon Valley Bank specialized in things that are directly impacted by inflation going up. One example is that they were heavily invested in bonds, which is a very normal thing for banks to invest in because they're safe and secure under almost all circumstances. However, when interest rates go up, the value of bonds go down. So a big part of Silicon Valley Bank's portfolio actually started declining in value. Additionally, they made a lot of loans for venture capital companies and venture capitalists based on valuations that were before interest rates started going up. What that means is that $1 billion company may now only be worth $250 million. As an added problem, because venture capital companies were making less money, venture capitalists and people in the field needed more cash. So they were withdrawing more money than they normally would on a monthly basis to sustain their lifestyles and keep the world moving. Silicon Valley Bank looked at it and said, oh, we have a problem because now they're taking all this money out of the bank and we only have so much cash on hand to cover these withdrawals. In response to this new problem, Silicon Valley Bank tried to sell off a big portion of their bond portfolio at a loss, but to bring in capital. And they also tried to do a stock sale so they could go out there and raise new money to cover the withdrawals. Well, as you can imagine, if you saw in the news that your bank was selling things at a loss and trying to sell shares to make enough money to have money to give you if you wanted your money, you might go into a panic. And that's exactly what happened. People panicked and then they did what's called making a run on the bank. When people make a run on the bank, it means that everyone generally panics at the same time and says, I don't know that this bank is going to have enough money to give me my money if I need it, so I'm going to go pull it all out really fast to make sure that I get mine. The problem is that when that happens, the bank doesn't have enough money to cover the withdrawals. They didn't even have enough money to cover the withdrawals that were already happening. So when everybody panicked and made a run on the bank, they almost immediately defaulted. Now, normally we have the security of the FDIC insurance policy, which is insuring up to $250,000 per account at a bank. While that's helpful for a lot of people, that doesn't really help these companies that much because they had tens, if not hundreds of millions of dollars with Silicon Valley Bank. As of this video, what has happened is the federal government has come in and said, okay, yes, the bank has defaulted. We do have the $250,000 insurance policy for FDIC limits. However, we are going to guarantee 100% of the funds that were in the bank so that people can get access to their money. I have already seen some complaining from people that the government is bailing them out, but it's really important to understand why they chose to make this decision. Now, this isn't a long video, but it's got a lot of information. So in case you forgot, earlier, we talked about how the companies that bank at Silicon Valley Bank have hundreds of thousands of employees collectively around the United States. They have leases, they have mortgages, and there's a lot of things that have to do with business everywhere globally in the United States that are banked here. Well, you can imagine that if these companies did not have access to their cash, they can't make payroll, they can't pay their leases, they can't pay their mortgages, and the United States economy is going to come to a screeching halt, which is going to be a massive problem. In order to avoid that, the federal government decided they were going to back 100% of the funds that were in the bank to make sure people have access to their money. Additionally, it's not uncommon for banks in this situation or heading toward this situation, which is much more common, to be purchased by a larger bank. They'll roll them into their infrastructure and they'll make sure that they can continue making money off the loans that were out in the universe, but they can also service the cash needs for the immediate clients. With all that being said, the big question is, what do your clients need to know when they ask, should I be worried about what's happening with Silicon Valley Bank and how does it impact me here in San Antonio? The short answer is that it's a bank that's specialized in venture capital backing, and that is a very, very different type of bank than the one that you and I will use on a day-to-day basis. Not only do most major banks have a really healthy balance of corporate, company, and retail people coming in, making deposits and holding cash there, they're also not over leveraged into a very specific area that can be directly impacted by one massive market change. So my advice would probably look a little bit different had the federal government not stepped in and ensured all that money was available, because then we would have had some serious panic in the economy. However, as it stands right now, the collapse of Silicon Valley Bank is really going to be a case study on what not to do going forward, but it should not have a major impact in the economy because a bank like that is simply not comparable to most of the major banks that you and I would use.